Hi there, and welcome to our three-part video series on our secret indicators to market success and trading profitability. The first one we want to talk about today is market breadth. My name is George Papazov. I'm the owner and founder of TRADEPRO Academy, and I'll be walking you through this video series to give you some insight on three indicator types that most professional traders use that the retail public has absolutely no clue about. Before we begin into this information, I want to remind you that what you're seeing today is intended for educational purposes. It's not to be taken as investment advice. The risk of trading in securities markets can be substantial. You should carefully consider if engaging in such activities suitable to your own financial situation. TRADEPRO Academy is not responsible for any liabilities arising as a result of your market involvement or individual trade activities. All right, now that the lawyers are happy, it's your turn. Let me start out by a brief introduction. In 2001, I started trading on my dad's advice in the Forex markets. I started trading currencies, mainly the US dollar versus XAU, which is gold. From there, I went on and took a class in school to learn about trading in the financial field, and they taught me nothing of what I needed to know in order to be profitable. So I started looking online, scouring the internet for resources I could read, look, digest, and hopefully to help me make some money. And it didn't work. There was very little out there that was applicable because everything focuses on picking market direction. And the truth is, you don't need to know the market direction. You need to read price action and be able to execute on an actionable trading plan. And that's what I put together this three-part series for you on secret indicators. From there, I started trading professionally, and I've been doing it since, teaching thousands of people literally how to apply this knowledge and how to become more financially better off through trading. And I hope that you become one of our next trade pros. Let me introduce you to this material. Before we begin and talk about what market breadth is, I want to start off with a quick analogy of a car. We know how to drive a car. We know how it works. Now, let's imagine that you're driving up a hill. So there's a hill that you got to climb up, and there's a flat road here on a valley, and then there's a peak. So you're chugging along in your car, and about 50 kilometers out from that hill, what happens? Your gas light comes on. So here's your car. I never went to art school, but that's my illustration. All right, that's the car. Let's say right here is the gas light on the dashboard, and the flash comes on, and you know you have to make a decision. Do you stop now and get gas, or do you stop later? You know what type of stretch you also have remaining in terms of your fuel. So here's the situation in trading. When you look at a stock chart, let's say this is a chart, you know the chart has volume as well underneath. The higher the volume, the more participants are getting on board this trend. Well, it's the same idea with your car. Your volume is your gas pedal. All right, so when the volume's increasing, you could assume that traders are stepping on the gas, they're putting their money into play, and they're either buying into the trend or selling out of it, depending on which way it's going. So your volume is your gas pedal in the car. But what is the gas light? And the gas light is what actually represents market breadth. And breadth indicates how much fuel is left in the tank. How much of your car is going to be dependent on you running out of gas. So if you're chugging along, back in this example, coming up to the hill, you got two options. If you didn't get gas before, you're going to try to climb up this hill and hope that you don't run out of gas. Now, that's the exact way that the market moves. It goes up, it goes up. Volume might be heavy, increasing on this uptrend. Why is that? Because you're hitting the gas more to try to climb this hill. However, what happens if volume is super heavy and you run out of gas? Despite how much you're hitting on your gas pedal, there's nothing left in the tank. The car's going to roll back and start to slide down the hill backwards. And that's what ends up happening. You ran out of gas. That's what market breadth indicates. It shows you the internals of a market, and very few traders are familiar with this concept. What's one way to gauge market breadth? I'll show you that right now. It's using these two indicators. First, before you begin this, you might want to introduce yourself to tradingview.com. It's a phenomenal trading platform, and it's free. If you want to sign up, click the link below, and we'll get you signed up on that. You could actually go in and set up your account for free, start trading, get a 30-day trial of the professional edition, and I strongly recommend it because you have access to a lot more of the tools. You're able to break up your charts into 3 components like this, whereas the free trial version does not allow you. And that's one of the many benefits. Click the link below and get started. Sign up on TradingView. Now, these are the two market breadth types. On the first chart, you're seeing SPY, and that is the SPY ETF. It mirrors the S&P 500 index. On the second pane below, you're seeing our market breadth indicator that we love, number 1, and that's the S5FI. That's a symbol for that chart on TradingView. What it represents is the percentage of stocks that are moving above a 50-day moving average in the S&P. Think about that. The percentage of stocks moving above the 50-day average. If you have more than 50% of the stocks moving above the 50-day moving average, what you actually have is positive sentiment. You got positive momentum. You got a rally. If you have less than that, then the market may be in trouble. Now let me explain how this indicator works. Like I said, it's the gas in the gas tank. Here is the S&P 500 climbing into the end of 2016 rally from Donald Trump. You could see stocks, the number of stocks that were going above their 50-day moving average, or the percentage of them, was above 50 mid-November. From there, you had the fuel to the fire and the catalyst to continue higher. This was your chance to start buying. What I've also done is I've applied a 50-day moving average to give us an idea of trend direction. As long as the percentage of stocks above 50-day moving average is trading above the 50-day moving average itself, you got a buying opportunity. If you start to notice that this indicator reaches 80 and above and starts stalling out, that's usually where the gas runs out of the tank, like you can see right here. And you could expect a sideways to downward move. You could see that when this happened in July, the tank was depleting in gas, and when it finally ran out, the car rolled down the hill. It's not an indicator that you could say as soon as this happens, do this, but you have to observe it and be logical about this. In today's market, we're seeing much of the same. We've seen a rally, okay? We hit the 80s, it's reversed, and the gas is starting to run out of the tank. The light is on below these 50s, the gas is starting to run out. If you don't have any more gas, what's going to happen? Your car is going to not make it over the hill and roll back down, and that's what the SPY is doing or looking to do in the near future. So watch for this market breadth indicator. The key levels to watch for is what percentage of stocks are above the 50-day moving average. Is it more than 50? If the answer is yes, you're looking to get long. If it's above the 50-day moving average as well, you're also looking to get long. Now you got two check boxes. It gives you more commitment and more probability to the upside. If you've already hit 80, it's probably time to stop buying. That trend may be overbought, and you could start to look into selling strategies. On the downside, if it hits the green and rebounds, it's probably time to start buying stocks and wait patiently. Maybe buy 1/3 down here. On the breakout of this 50-day moving average, buy another third, and on the break of 50 on the actual reading, buy a third. So this is your market breadth indicator. It's telling you what are the internals saying. Is it strong? Do we have gas in the tank to move higher? The other one that I like to follow is S5OH, and that stands for 100. That's a percentage of stocks above the 100-day moving average and the S&P 500. Okay, and this indicator moves slower, all right? But when it hits these extremes above 80, it tells you a lot more information. It's a lot stronger of an indication. This is, if I had to compare it, this is your regular gas tank, and this is your reserve. Once this gets up there, you're really running into trouble. Where the opportunity comes is if you have the 50-day up in an overbought area and in a sell zone, and you have the 100-day in overbought and sell zone area, and they start to both move out of that box and hit below the 50s, you got such a great opportunity to start looking for shorts and get paid on a high probability move. It doesn't mean the market's going to go down to zero, but it means the next 30 to 50 points on the S&P 500, and if you're on the ETF, the next $1 to $2 max is to the downside, and you have a high probability trading opportunity. Now, when these internals hit a buy zone together, you start to look for a long opportunity. The retracement or the downside is probably over. Wait for these three things to happen. Wait for the percentage of stocks above the 50-day to go above this 50 moving average, which is the red line, and wait for the break of the 50 moving average on the 100-day average breadth indicator. And what you get here is a November 15th entry, and you literally had some great upside, and hold it until it becomes overbought and hits these red areas. All right, on the 50. The 100 is more of a longer term outlook, and you want to look at it around 70 to 80. It starts to become overbought. You could see any of these territories that reverse, at least temporarily. And we're not quite there, which means from a longer term perspective, we still got upside on this market. The shorter term perspective, the 50-day moving average breadth indicator is starting to drop below 50. It's starting to worry the market. We could see some downside, but watch for what this 100 does as well for it to confirm. From there, you can start shorting this market until what? Until it hits the green, and then watch for a bottoming out like this. Wait for them to climb back out of this green zone and start buying. If you have any questions, please let me know. Email me at TRADEPRO Academy. I'd love to help you out and discuss this with you. But here's one very powerful way you could apply one of my top secret indicators, market breadth, to your own trading, and it'll make a significant impact and a significant difference. Because if someone's slamming on the gas and it's about to run out of gas in the tank, you need to know that. And now you can know that with this market breadth indicator using percentage of stocks above a 50 and a 100-day moving average. I hope you enjoyed this information. If you have any questions, let me know, and I'll see you tomorrow for our second secret indicator, and that will look at how to gauge if market has aggressive buyers or aggressive sellers, and more importantly, what to do with that information. See you in the next video. I hope you have a phenomenal day, and I hope this has been extremely helpful.